Now, at a place like Berkshire Hathaway or even the Daily Journal, we've done better than average. And now there's a question, why has that happened? Why has that happened? And the answer is pretty simple.
Hello, fellow intelligent investors. My name is René Zellman. And as you can tell by that little intro clip, today I want to talk about Charlie Munger's investment philosophy and how he and Warren Buffett achieved their very impressive investment track record. So without further ado, let's get started.
Have you ever wondered how you can make your hard-earned money work for you? Have you ever dreamed of building generational wealth and leaving a legacy? My name is René Zellman, and I'll teach you how you can manage and invest your money with confidence, a long-term vision, and without losing your mind. Join me on my journey of intelligent investing and learn how smart people can compound their money effectively and accumulate wealth.
Alright, fellow intelligent investors, so in that intro clip, Charlie Munger asked the question why he and Buffett did so well over the course of many decades. Now, maybe we first of all need to verify that these two investing legends did particularly well and were able to beat the market quite handily. So if we consider Berkshire Hathaway, the business conglomerate that is owned and run by Warren Buffett and Vice Chairman Charlie Munger. Well, most of you will probably know that Buffett is allegedly the best investor of all time, achieving an impressive compounded annual return of roughly 20% since buying Berkshire Hathaway back in 1965. And there's actually a website that allows you to determine how rich you would be if you invested a certain amount in Berkshire Hathaway at some point in time. And I will add a link to that website in the description box below. For example, if you invested $1,000 in Berkshire Hathaway right at the beginning of this wonderful journey in 1965, your investment would be worth $18 million today. And if you invested $1,000 in 1990, that investment would be worth almost 50x your initial investment, so almost $50,000. Now, of course, Charlie Munger played an important role in achieving these impressive returns. Without Munger's influence, it seems very unlikely that Berkshire would have grown to the size it reached today. And that's because Buffett's investment philosophy during his early years is what is commonly referred to as a cigar butt investment approach. Metaphorically speaking, cigar butt investors basically pick up a cigar butt off the sidewalk. And while this cigar butt is certainly not very appealing and unattractive, it is pretty much for free, and thus the bargain price means that the last puff left is essentially pure profit. And to quote Buffett himself here, he said, "Cigar butt approach to investing is where you try and find a really kind of pathetic company, but it sells so cheap that you think there's one good puff left in it." Basically, the approach focuses on buying beaten down businesses that are trading below a conservative assessment of their liquidation value. Now, what I think is important here is to acknowledge that there's a major difference between liquidation value on the one hand and intrinsic value on the other hand. I think if you want to learn more about this distinction, I'm just going to recommend my video on the concept of book value here. Now, to get back to my point here, Charlie Munger's influence was so important because the cigar butt investing approach, this approach does not scale particularly well, and Berkshire pretty quickly reached a size that required Buffett and of course his partner Munger to transition to a more scalable approach. In January 2017, in an interview with Charlie Rose, Buffett himself explained what Munger brought to the partnership and how he helped make Berkshire what it is today. So let me show you a clip from that interview.
Both of you have chosen both wives and partners well. Charlie Munger added what to you?
Charlie Munger changed my views. He refined them in a huge way in terms of looking for the quality companies and looking for the ability to make an investment that would work out well for 5 or 10 or 20 years as opposed to something there might be one, I call it cigar butt investing, where there was one puff left in the cigar, but the cigar was free, so you picked up these disgusting looking things and got one puff out of it and one onto another one. And that worked okay, but it was small scale, and it really doesn't build something satisfying. So he he kept forcing me in the direction of saying, is this really a business we want to own for forever? And do we want to get associated? It's like a marriage. I mean, do you want to get associated with this person forever? And it's a great way to look at things.
Now, in addition to that interview, I can also highly recommend the Berkshire 2014 shareholder letter, in which Buffett himself explains why Charlie Munger convinced him to break his habit of investing in cigar-bird companies. He wrote, "It took Charlie Munger to break my cigar-bird habits and set the course for building a business that could combine huge size with satisfactory profits. Charlie's most important architectural feat was the design of today's Berkshire. The blueprint he gave me was simple. Forget what you know about buying fair businesses at wonderful prices. Instead, buy wonderful businesses at fair prices." And if you haven't read this letter, I think it's a must-read for all investors. And of course, I will add a link to that letter to the description box down below. Now, Buffett and Berkshire's transition. Well, that's not really the point of this video. The point that I want to make in this video is why Charlie Munger and Warren Buffett were able to beat the market for so many years. And before we listen to Charlie Munger here, let me know in the comments down below what you think. Why were the two of them able to beat the market for decades? And why do you think you will be able to beat the market, which is certainly a very challenging task? So let's listen to Charlie Munger.
Now, at a place like Berkshire Hathaway or even the Daily Journal, we've done better than average. And now there's a question, why has that happened? Why has that happened? And the answer is pretty simple. We tried to do less. We never had the illusion we could just hire a bunch of bright young people and they would know more than anybody about canned soup and aerospace and utilities and so on and so on and so on. We never had that dream. We never thought we could get really useful information on all subjects, like Jen Kramer tends to have. And we always realized that if we worked very hard, we could find a few things where we were right. And that a few things were enough, and that was a reasonable expectation. That is a very different way to approach the process. And if you had asked Warren Buffett the same thing that this investment counseling did, give me your best idea this year, and you just followed Warren's best idea, you would find it worked beautifully. But he would, trying to know the whole, he would give you one or two stocks. He had more limited ambitions. And I knew Grandpa Hingham was right. And so I always knew from the very first, when I was a little boy, that the opportunities that were important that were going to come to me were few, and that the trick was to prepare myself for seizing the few that came. This is not the attitude they have at a big investment counseling thing. They think if they study a million things, they can know a million things.
So, there you have it. The recipe for their success was doing less. Isn't that amazing? I think successful investing is to some extent counterintuitive, because in many areas of life, activity and action is what moves the ball forward. Activity usually gets rewarded. For example, if you are an athlete and you want to be stronger, what do you do? Well, you go and run more miles. Maybe you go more often to the gym. And if, on the other hand, you want to be more knowledgeable, you will read more books and talk to smart people. But in investing, the more you do, the worse your outcome. And being somewhat lazy and complacent can actually be a positive attribute if you are an investor. I would say that in a way I already addressed the idea of being lazy and doing very little in my recent video on the power of snap judgments. In that video I presented a list of questions that allows you to reject investment ideas very quickly and to focus on the no-brainers. Warren Buffett, he has made the point that disqualifying investment ideas as quickly as possible is basically your main job as an investor. And this allows you to consider many different ideas and, as I just said, to then focus on the no-brainers. And as Charlie Munger has pointed out, focus on those companies where you feel very comfortable that you can actually understand the business the company is engaging in. And later during that Daily Journal meeting, Charlie Munger made it very clear that he thinks almost no one can actually beat the market, can outperform an index fund. Let me just show you the end of that clip.
And of course, the result is almost nobody can outperform an index. Whereas I sit here with my Daily Journal stock, my Berkshire Hathaway stock, my holdings in Lilu's Asian fund, my Costco stock, and of course I'm outperforming everybody. And I'm 95 years old. And I practically never have a transaction. And the answer is I'm right and they're wrong. And that's why it's worked for me and not for them. And the question is, do you want to be more like me or more like them?
So, why can almost no one outperform an index fund? Well, I would argue that what makes investing so hard is that it requires a certain temperament. And as human beings, we naturally suffer from many cognitive biases that try to interfere with an intelligent investing approach. And obviously, there are also psychological biases that make it hard to do very little. This bias is commonly referred to as the so-called action bias, which describes our tendency to favor action over inaction. Let me just give you a very powerful example here. There's actually empirical evidence that human beings feel compelled to act, even if this will lead to a worse outcome. There's a study by Eli et al., who analyzed how the action bias influences goalkeepers in the context of penalty kicks. The researchers discovered that due to the probability distribution of penalty kicks, the optimal strategy for goalkeepers would actually be to stay in the center of their goal. According to their dataset, if a goalkeeper stays in the center of the goal, he or she would save 60% of the kicks that are aimed to the center, which is far higher than the 30% savings rate when the goalkeeper dives to the left or to the right. However, the goalkeepers were clearly affected by the action bias because they hardly ever chose to remain in the center of their goal, and they prefer to either dive left or right in 94% of the cases. So the researchers' explanation for this was actually quite simple. Basically, doing nothing and then conceiving a goal amplified the negative feelings goalkeepers experienced. So if they did something and then conceived a goal, that wouldn't bother them as much as if they would just stay in the center of the goal. And similarly, I think investors feel like they can improve their returns by doing a lot too. But as we explained, in the world of investing, doing nothing can actually be an effective strategy to boost your long-term returns. And I think investors need to acknowledge that inactivity can also be a conscious decision. And the Daily Journal is a great example showing that inactivity can work wonders. Maybe for starters, the Daily Journal Corporation is, to some ways, Charlie Munger's Berkshire Hathaway. Munger has used the company and its cash flows to acquire a basket of undervalued stocks or securities over the course of the last decade. And basically he borrowed the same model that Buffett has used at Berkshire Hathaway for decades too. And if we just consider what Charlie Munger has done over the course of the last 10 years, we can see that he did almost nothing, and nowadays he only owns 5 securities. In fact, it might be 6, because it seems plausible that Daily Journal has actually made an investment in a foreign company by a BYD, which is not disclosed in 13F filings. But still, it's a highly concentrated portfolio. Munger certainly invested a lot of money during the financial crisis when lots of companies were available at discount prices. But since then, he has been waiting patiently for another opportunity, which he might have found quite recently in Alibaba actually. I did a video on that transaction. But clearly, Charlie Munger is doing very little at the Daily Journal Corporation. All right, I think that should be it for today. The bottom line here is actually quite simple. I think as an intelligent investor, you need to be okay with inactivity. Just be a good stock picker and then hold your investments for the long term. And as always, may your finances and investments prosper. Good luck.